Hello everyone and welcome to episode 39 of JustDario Cigar Time. Today I want to explore the dangers of ignorance taking over financial markets. But before doing so, it is important to clarify the meaning of ignorance in financial markets. Ignorance refers to the failure to fully understand the complex factors that drive the pricing of financial securities, whether they rise, fall, or react to a specific event like paying coupons or dividends. These factors are multifaceted. Direct influence include company-specific metrics such as earnings, cash flow, or balance sheet health. For example, a firm's price-to-earnings ratio or debt levels are expected to directly impact its stock valuation. However, indirect forces stemming from the broader economy, industry dynamics, and macroeconomic conditions are equally critical. Overlooking direct and indirect factors that influence the trading of a security can, of course, lead to mispriced assets and poor investment decisions. Many assume ignorance is primarily a problem for retail traders, but that's a misconception. Retail traders, often operating in very volatile environments, tend to be acutely aware of their information gaps. Data from the SEC reveals that during the 2021 meme stock frenzy, retail trading accounted for over 25% of US equity volume, and participants frequently adjusted positions swiftly, using tools like stop-loss orders to mitigate risks, avoiding some of the deeper losses that institutional portfolios incurred. This suggests a heightened sensitivity to price fluctuations and risks among retail traders, contrary to the stereotype of reckless gambling. Conversely, professional traders, whether independent or at large financial institutions, often rely on assumptions and conventions they believe are grounded in robust quantitative models. Yet, history shows that behavioral biases and qualitative judgments heavily influence those models meant to be quantitative. The 2008 financial crisis is a stark example. Quantitative models at firms like Lehman Brothers underestimated tail risks under the assumptions that those extreme events had zero probabilities to impact sectors that always went up, like real estate. Overconfidence and anchoring on historical data without accounting for structural shifts in markets often lead professionals astray. These sections set the stage for understanding ignorance not as a lack of knowledge but as a failure to integrate the full spectrum of factors, both micro and macro, that shape market outcomes. As we move forward, we'll see how these missteps are manifesting in today's trading practices. Common belief in today's markets is that professional traders, particularly in the institutional sector, rely on sophisticated trading algorithms and quantitative strategies to eliminate human error. However, this is a significant misconception. While algorithmic trading now dominates, accounting for over 60% of US equity volume, according to a 2024 report from the Bank for International Settlements, these systems are far from infallible. The critical oversight is that algorithms are designed, programmed, and parameterized by humans. As a result, they inherit human biases, flawed assumptions, and occasional miscalculations. The 2010 flash crash exemplifies the fragility of algorithmic trading, where high-frequency systems amplified a single large sell order into a 1 trillion market plunge in minutes, as detailed in the SEC CFTC report. These algorithms, reacting uniformly to signal without contextual understanding, revealed their core weakness, an absence of adaptive reasoning. A similar near catastrophe occurred on August 5, 2024, when global markets neared a flash crash. The VIX, a key volatility gauge, surged above 60 in US pre-market trading, driven by algorithms chasing extreme momentum from a 12.4% plunge in the Nikkei 225, Japan's worst drop since 1987. Headlines speculating about a swift Federal Reserve emergency rate cut, though unrealized, sparked enough optimism to reverse momentum, averting a global collapse. More recently, on April 2, 2025, dubbed Liberation Day, President Trump's announcement of sweeping tariffs, a 10% baseline on all imports and up to 49% on specific countries, triggered a sharp market reaction. Trading algorithms programmed to monitor geopolitical risk slashed equity exposure, with proprietary trading firms reducing US equity position by an estimated 20% intraday, according to Algorithmic Securities data. Momentum algorithms exacerbated the sell-off, driving the S&P 500 down 10.5% over 2 days, while volatility control strategy designed to capitalize on VIX spikes began buying volatility derivatives as the VIX hit 50.83. This amplified market turbulence, with bid-ask spreads widening dramatically. However, on April 9, a 90-day tariff pause announcement sparked a dramatic U-turn, fueling a 9.5% S&P 500 rally, the 10th best day in its history. Bullish momentum algorithms reverse course, unwinding prior sales and driving a surge in equity exposure, highlighting how fragile sentiment rather than fundamentals can dictate market swings. These events underscore the dangers of algorithmic herd behavior, where interconnected systems amplify localized shocks into global volatility, exposing the persistent risk of over-reliance on automated trading devoid of human judgment. What's more concerning is the perception that these strategies are inherently intelligent and flawless. This over-reliance can lead to herd behavior, creating self-fulfilling prophecies in the markets. When multiple algorithms follow similar logic, they amplify trends, whether bullish or bearish, often detached from fundamentals. People trust these systems too much, assuming positive outcomes validate their correctness. But when everyone follows the same strategy, it doesn't mean they're right. It often means they are all vulnerable to the same blind spots. Herd behavior rooted in human-designed algorithms can distort markets significantly. It sets the stage for overreactions and mispricings. A striking example of market ignorance surfaced this week, capturing my attention. Traders in the future markets at some point priced in a 106% probability for the Federal Reserve to cut rates at the next FOMC meeting in September 2025, as displayed on the top left corner of the Bloomberg terminal now on screen. How can a probability exceed 100%, which represents absolute certainty? This anomaly highlights a critical flaw in market pricing mechanism. In Fed Fund futures, probabilities are derived from contract prices, which reflect bets on the effective federal fund rates. The SMCI FedWatch tool calculates this by subtracting the futures rate from the current target rate and dividing by the potential cut size, for example, 25 basis points. If traders aggressively price in more than a full cut, say anticipating 50 basis points or dovish forward guidance, the math can yield probabilities over 100%. This occurred briefly in July 2024 when probability hit 99% for a September cut, but implied over 100% when factoring in multiple cuts. Such distortions arise from overexcitement and convexity in future pricing, not from a genuine belief in a more than certain outcomes. As I noted immediately on X, this reflects traders getting ahead of themselves, implying undue certainty in an uncertain outcome. As I argued many times already, recently in Why Instead of Fixing US Problems, Fed Rate Cuts Will Worsen Them, the case for Federal Reserve rate cuts in the current environment is fundamentally flawed and risks exacerbating an already enormous financial market bubble. The Fed should raise rates to reset market functionality and ensure efficient capital allocation, prioritizing the real economy over speculative excess. Persistent inflationary pressures, evidenced by the July 2025 PPI surging 0.9% month over month, far above the expected 0.2%, and reaching an annual rate of 2.6% as per BLS data, signal that inflation remains a significant threat. Core PPI, excluding volatile food and energy, also rose 0.9%, pushing the annual core rate to 3.7%, the highest since March 2025. How can PPI sustain elevated levels since 2020 with corporate margins holding steady or improving, with the S&P 500 net profit margin that hit 12.5% in Q2 2025 according to FactSet, while the consumer price index chronically lagged behind when companies constantly raising their prices to boost revenues should have instead resulted in a much higher CPI, at least equivalent to the PPI. Logically, rising producer costs with stable margins should push consumer prices up, not down. Historically, CPI lags PPI by 3 to 6 months, not by years. Many independent reports highlight real-world prices surged a lot. Groceries up 20% since 2022, home prices rising 5% annually despite higher inventory, and rents climbing 7% in major cities. The answer to my question is clear. CPI data is being significantly underreported by the BLS, masking true inflationary pressures but also inflating the real GDP figures. This distortion fuels a false narrative of a robust economy, driving stock market valuations to unsustainable heights. Algorithmic traders, heavily reliant on headline data, falter when data integrity erodes. These misaligned strategies amplify market distortions, particularly as loose financial conditions persist. The M2 money supply has grown 4.2% year over year as of June 2025, as per Fed data, flooding markets with liquidity that inflates asset prices rather than fostering productive investments. Current level of interest rates, while straining sectors like real estate, where existing home sales plummeted to 3.89 million annually in June 2025, the lowest since 2010, amid mortgage rates above 7%, is insufficient to curb speculative excess. Raising rates further would tighten financial conditions, forcing capital to flow towards high-value real economy projects like manufacturing or infrastructure, rather than speculative bets on overhyped tech stocks or unprofitable AI ventures. Rate hikes would also temper inflation, aligning CPI more closely with PPI and restoring market discipline. By contrast, rate cuts would pour fuel on an already overheated bubble, risking a catastrophic collapse of markets with immense damage to the real economy, as seen in the 2000 dot-com bust and 2008 financial crisis. Premise of a robust U.S. economy has fueled record stock market highs across the globe, but cracks are forming. Mainstream media like the Financial Times and The Economist are now questioning the bubble. The Economist this weekend warned that Palantir, valued at $430 billion, 600 times trailing earnings, is potentially the most overvalued stock in history. As I said many times on X, Palantir is a 20-year-old big data firm, isn't a true AI leader, yet hype drives its valuation. Early, the AI data center frenzy, with McKinsey forecasting $5.2 trillion in investments by 2030, lacks profit justification. AI cloud displaced 85 million jobs by 2025, according to the World Economic Forum, and data centers might consume 8% of US power by 2030, according to EIA, raising costs without clear economic benefits. The current bubble mirrors the dot-com era and the 2008 bubbles at the same time. As I stated in previous episodes, I expect the whole bubble can hold up for a couple more quarters for various reasons, but I would like to provide an important clarification today. The AI big tech sector, led by firms like NVIDIA, will likely burst first due to unsustainable overspending, chronic unprofitability, and restrictions, as I discussed in detail in How Big Tech Spending Spree More and More Resembles 2000 TELECOMS Epic Fail, and NVIDIA and SMCI stocks will crash, according to Game Theory. These are paper giants, not economic linchpins. Furthermore, the notion that NVIDIA crash will devastate the real economy is a myth rooted in market ignorance. Unlike the systemic risks posed by sectors like commercial real estate, where 20% office vacancies threaten 1.5 trillion in debt maturities by the end of this year, according to Moody's. Over the weekend, I kept seeing posts on X claiming NVIDIA is too big to fail, or NVIDIA is too big to be allowed to fall. Yet, from January to April 2025, NVIDIA stock plummeted from $140 to $90, erasing approximately $1.2 trillion in market capitalization. Did this trigger a collapse in market functionality or disrupt many people's daily lives? Not really. The real economy marched on unaffected by these paper losses. This exposes a critical misunderstanding. NVIDIA, with a total assets of $125 billion, is dwarfed by true systemic giants like JP Morgan Chase, with $4.3 trillion in assets. JP Morgan failure would ripple through credit markets and consumer spending. NVIDIA will not. Investors' failure to distinguish between a company's stock price and its intrinsic value fuels this delusion. Companies like NVIDIA, trading at obscene valuations, aren't necessarily vital for the real economy. Their inflated market caps reflect speculative paper value, not economic significance. Consider Palantir, with a $420 billion market cap compared to Bank of America $350 billion market cap. If Palantir's stock crashed to zero tomorrow, the impact on markets and broader economy would be almost negligible. no disruption to supply chain or consumer behavior. But if Bank of America, with $3.3 trillion in assets, collapsed, it could freeze lending, devastate small businesses, and trigger a systemic crisis. NVIDIA isn't too big to fail or too big to be allowed to fall. It's simply the largest bubble in today's market, echoing past excesses like Enron before its 2001 collapse. Fun fact, NVIDIA replaced Enron in the S&P 500 in 2001. When stocks like NVIDIA inevitably correct to their fair value, it won't end the world. Another company will replace them in indexes like the S&P 500. Ignorance has inflated the exuberance, but as skepticism grows, evidenced by recent Financial Times or Wall Street Journal warnings about tech valuations, a cascade looms. This is why I suggest everyone once again to stay very vigilant.
Thanks a lot for listening to my episode again today, for liking the video, for subscribing to my YouTube channel. I would like to remind you the special offer that we have at Synax till the 30th of September to access 1 month free unparalleled stock market intelligence and then lock in a 1-year subscription for just $15 US. Thanks a lot for supporting me on X, for following me on Instagram, and for reading and commenting my articles on JustDario.com.